Topic introduces implied volatility, a forward-looking measure of expected market volatility derived from option prices. Unlike historical volatility, which is calculated from past asset price movements, implied volatility reflects the market's consensus regarding future uncertainty over the life of an option. In option pricing models such as Black-Scholes, implied volatility is the variable that equates the theoretical option price with the observed market price. The program emphasizes that implied volatility is one of the most important indicators in derivatives markets because it incorporates investor expectations, risk sentiment, and anticipated future market conditions directly into asset pricing and risk management decisions. The topic explains that implied volatility is not constant across strike prices and maturities, giving rise to volatility smiles and volatility skews. Under the standard Black-Scholes assumptions, implied volatility should theoretically remain constant for all options on the same underlying asset. However, empirical evidence shows that deep in the money and out of the money options often exhibit higher implied volatilities than at the money options. This pattern reflects market concerns regarding tail risk, asymmetric return distributions, and the possibility of extreme market events. The topic highlights that volatility smiles became especially important after major market crashes revealed the limitations of assuming normally distributed returns. Another important topic discussed is the relationship between implied volatility and market uncertainty. Rising implied volatility generally signals greater investor fear, economic uncertainty, or expectations of large future price movements. Equity market volatility indices, such as the VIX, are constructed using implied volatilities from option prices and are widely viewed as measures of market sentiment or fear gauges. Because implied volatility reflects real-time expectations rather than historical outcomes, it is extensively used in trading, portfolio hedging, stress testing, and risk forecasting. The program emphasizes that implied volatility is often more informative for forward-looking risk management than historical volatility measures alone. Topic examines alternative methods of studying volatility beyond traditional historical standard deviation analysis. One major approach involves autoregressive conditional heteroscedasticity, ARCH, and generalized ARCH (GRCH) models, which recognize that volatility changes over time and tends to cluster. Volatility clustering refers to the empirical observation that periods of high volatility are often followed by additional high volatility periods, while calm periods tend to persist as well. These models dynamically update volatility forecasts based on recent market behavior, making them highly useful for value-at-risk VAR, derivative pricing, and financial forecasting applications under changing market conditions. The topic also discusses realized volatility and high-frequency data analysis as alternative approaches for studying market variability. Realized volatility uses intraday price movements to estimate actual market volatility more precisely than daily return measures. This methodology allows analysts to capture short-term market dynamics, jumps, and intraday fluctuations that may be missed by lower-frequency data. Additionally, stochastic volatility models treat volatility itself as a random process evolving over time. These advanced approaches improve the ability to capture changing market uncertainty, fat tails, and nonlinear dependencies. The program highlights that different volatility models are appropriate for different financial applications depending on the desired balance between complexity and forecasting accuracy. Overall, topics demonstrate that volatility is a dynamic and multifaceted concept central to modern financial risk management. Implied volatility provides market-based expectations of future uncertainty, while alternative methods, such as GRCH models, realized volatility, and stochastic volatility frameworks, offer more sophisticated approaches to modeling changing market conditions. The program emphasizes that no single volatility measure is universally superior because each captures different dimensions of financial market behavior. Effective risk management, therefore, requires combining multiple volatility estimation techniques with stress testing, scenario analysis, and professional judgment to assess uncertainty accurately across varying market environments and asset classes.